Hello and welcome to a webinar presented by OJM Group. My name is Jason Odell. I'm one of the principals at OJM Group, and I'm here today with Michael Llewellyn, who is the director of our financial planning division. We're going to cover the topic strategies to reduce volatility and improve tax efficiency in one's portfolio. Prior to getting into our discussion today with Michael, there are some disclaimers here that I want to share with you. What's important to take away from these disclaimers is that you need to work with an advisor or professional that's licensed in a specific discipline and properly registered. That's very important to do. You need to make sure that the advisors you work with have proper credentials. We also have a number of different materials for any of the webinar attendees today that we are happy to provide free of charge. We've got different books that we will provide to you information on how to download via our online bookstore at the end of this presentation. In addition, we have a book that is new in 2017 titled Wealth Management Made Simple. Again, we're going to offer a free copy of this at ojmbookstore.com, and we'll provide to you a code at the end of the webinar that will allow you to download this book for free. Or in the event that you'd like a hard copy of it, you can contact us directly and we'll be happy to mail you out a hard copy of it. So now to talk about today's webinar, we're going to cover cash value life insurance as an asset class. And Michael is going to explain to us the various types of cash value life insurance, how this particular tool can limit volatility and potentially improve tax efficiency in one's portfolio. We'll also cover in there things that you ought to consider when considering this particular tool. What are the pros and cons of using this particular tool? So now let me introduce to you again our presenter today, Michael Llewellyn. He's a certified financial planner. He's the director of financial planning for OJM Group. So Michael, everybody's sort of familiar with a pie chart here and the various different asset classes and types of underlying investments that are in here. However, you do have in here cash value life insurance. Will you speak to why you believe cash value life insurance is important to have in a diversified approach to one's portfolio?
Sure. Well, any piece of the pie needs to have a reason for being included in an overall diversified approach. Cash value life insurance offers the benefit of less correlated returns. So it can act as a hedge on your traditional investments. So your stocks, bonds, mutual funds, for example. It also has a preferred tax treatment. If a policy is designed correctly, the cash buildup grows tax-free and can also be accessed tax-free. So it can also act as a tax hedge against your portfolio.
Great. So when you're considering this type of a vehicle, will you talk a little bit about the different types of cash value life insurance and how each of them work?
Sure. Well, there are really four main options when it comes to using cash value life insurance. The first being whole life insurance. So what you're doing here is you're paying your premiums to the carrier, they're investing them, and then they're giving you a dividend in return, or they're crediting you a dividend. It ends up being more like a bond-like return. Now, the advantage of a whole life contract is that the guarantees generally are going to be better than in other types. The issue that you run into is that it's also less flexible from a design standpoint, and the cost can be higher throughout. A universal life policy is one your earnings are based upon the carrier's fixed account. So the carrier declares an interest rate that they'll be paying you, and you get credited that every year. Now, just a pure universal life contract, the primary reason there is for death benefit. So it's not generally for cash accumulation. Equity index or index universal life is a type of universal life, but the way that you're credited is based upon a collared strategy. And what that means is you pay your premiums to the carrier, they purchase options, calls, puts, different things to guarantee a collared strategy. And what that means is, so there's a floor, think of a floor. If the market were to go down 20%, you're going to be credited zero. If the market were to go up 20% though, there's a cap on the upside. So you're only going to get, think 10%. And your performance is tied to an index, so think the S&P 500. Now, a variable universal life contract, the way that this works is you pay your premiums and your dollars are actually invested in mutual funds that you select inside that contract. So just like with your 401k where you're able to go in and pick different funds, that's what you're doing there. If the market goes up 20, you get all of it. If the market goes down 20, then you lose 20% as well.
So when you're talking about limiting volatility, are you referring to using equity index universal life insurance policies?
Yes, we would say that's the one that has the best opportunity to limit volatility. So if we look at this graph here, we can see we're looking, the light blue would be the S&P 500 with dividends, the darker blue, the S&P 500 without dividends, and then the yellow is the equity index, the one with the floor of 0 and a cap of 10% on the upside. So if it goes up 20, you're going to be limited just to that 10%. Now, if you see in a vacuum, the light blue is the best, especially over the time period that we're looking at. That's going to give you the greatest return. But in retirement for clients, we don't know when those big dips are going to be. So if you look the early 2000s where there was a big dip, 2007, 2008, where there was a big dip in there as well too. So the idea, if you look at the yellow, it's that smooth ride. And that's the goal there, is to try to limit volatility for a portion of your portfolio.
I think the other important thing on this slide too, Michael, is that standard deviation box on the left-hand side, which standard deviation is a measure of volatility, or another way to say it is how much risk does one need to take in order to achieve a specific return. So the higher the standard deviation, the greater the amount of risk one is taking to get an underlying return. And what you'll notice is that the S&P 500 with dividends has a 16.78% standard deviation. That standard deviation then, as you can see, is an average return of 11.73%. In the indexing strategy, you've got a standard deviation of 4.45% with an average return of 6.41%. So what does that mean? That means that to get the S&P with dividend return of 11.73%, you're going to take 4 times more risk than you would with an indexing strategy to earn a 6.41% crediting rate. So you're taking 4 times the amount of risk for really about a 5% increase in return in this particular strategy. So that's an important thing to know. One of the other things that we believe is advantageous in cash value life insurance is that it provides an opportunity to improve tax efficiency. Talk a little bit about that, Michael.
Yeah, so if you look at these charts, we're looking at historical income tax rates and then capital gain rates. And the only thing that I can tell you that I know for sure about taxes in the next 20, 30, 40 years is that I really have no idea where they're going to be. So the only way to hedge against taxes is to remove them, or to remove them as much as you can. And that would be the goal with using cash value life insurance.
So that brings us to the concept of the tax buckets. Please explain that.
Yeah, so the idea is to have a diversified approach with your retirement assets, obviously. We also want to do that within those assets from a tax standpoint. So if you look at the 3 buckets here, the first being the green bucket is what we would call the income bucket. So think about your 401ks, traditional IRAs, any pension, anything like that. So those dollars are going in, they're growing tax deferred. The majority of the time, especially with your 401k, you're getting a tax deduction for them. But when you take them out, they're going to be taxed as regular income. So we don't, again, while we don't know what income tax rates are going to be, it's still advantageous to get the tax deduction on the front end, generally, especially with your 401k. If you look at the orange bucket, that's what we would call your taxable bucket or the capital gains bucket. So the exposure here is going to be taxed at a capital gains rate. This is going to be anything that's in your taxable account or a brokerage account, stocks, bonds, mutual funds, that type of thing. Real estate could also fall into that category as well too. So when anything is going to be sold, you're going to be paying capital gains. And the advantage of the capital gains tax, obviously, is that it's lower than the income. You want to be diversified into both, right? Obviously, and then also into the third one, if you have the ability to. And that would be what we would say is the overlooked asset or the tax-free bucket. So the best example, the Roth IRA, people are most familiar with. You put dollars in, grows tax-free, everything comes out tax-free. Municipal bonds historically would be an example of that as well too. But cash value life insurance fits into that bucket as well. So again, you put dollars in, they grow tax-free, and you're able to pull them out tax-free. So you're able to hedge against future tax rates.
Great. This all sounds fantastic. Is there a catch?
I'm not sure I would say that there is a catch, but there are definitely some things that you want to consider. The first being the expense on the front end. So the expenses inside of a life insurance contract, a cash value life insurance contract, are generally front end loaded. There are some situations where they can be high throughout, but for what we're talking about in an equity index universal life, the first 10 years, the expenses are generally going to be higher. So that's something you want to take into consideration. The example I use for anyone that's considering it is, this isn't buy boat money. So ideally, you're not going to want to pull money out of this in the first 10 years or so. That would be the one thing, and probably the most important thing you would want to consider. Also, policy charges. You want to make sure that you're with a carrier that historically has maintained current charges. So you can see on there what we're talking about. When you apply for any policy, there's current charges, and then they have the ability to go to maximum charges. Generally, you don't see them do that on a block of business. What you generally see them do is issue a new type of product or policy where they're increasing it. But you want to make sure that you're with a carrier that historically has not increased charges on their in-force book of business. You also want to make sure that your policy is designed the right way. The IRS does have rules when it comes to cash value life insurance. So you want to make sure that your contract is structured in a way that it's not a modified endowment contract, or a MEC being the popular term. If it is a MEC, then you lose all of the tax benefits. So you want to make sure that it's designed right on the front end, and then also that it's designed in a way on the back end that you're able to take cash out of it without creating a MEC. Those are all very important things that we want to make sure that anyone takes into consideration from a design standpoint. I think, as we move towards the end of this, also for anyone that's interested in having the analysis done of would something like this make sense, we would be happy to do that. When we do that, we look at the tax aspect of it. So we compare a cash value life insurance contract to investing in an after-tax account, and we also take a deep dive and we really look at the expenses of that contract, and we show that to anyone. Also, if you already have a policy, we're happy to do a review of that policy to see if there's any opportunity for you to improve. Contracts are always getting better. Carriers are always doing things to improve it. Also, we talked about 4 different options there. You really want to make sure that you're in a product that is designed to be able to take cash out on the back end. A lot of times, some of the older contracts have some expenses inside of there, and if you're healthy, there may be an opportunity for you to improve and move to a better product. And we'd be happy to do that analysis for you as well too.
Great, thank you, Michael. Appreciate it. That's some valuable information. Some things about OJM. We're a unique fee-based wealth management firm with clients in 48 states, and we have a multidisciplinary approach that we take in working with clients. We'd be happy to schedule with anybody on this webinar a free, confidential, no obligation initial consultation to discuss either your corporate or your personal planning needs. We'll also be able to determine in the various areas and how we work with clients, how we might be able to be a resource to you, either with all of these various areas or in one of them specifically, depending on your particular strategy. As I mentioned at the beginning, we're happy to provide anybody a copy of any of our books or our most recent book, Wealth Management Made Simple. You'll receive that by visiting our bookstore at ojmbookstore.com and to use the promotional code OJMWEB at the checkout to receive a free copy. In addition, you can contact Michael or myself at the information listed on your screen with any questions you might have. Thank you for listening and have a good day.